Welcome to GP Bullhound's Tech Thoughts, a weekly overview of economic developments in international markets. Today's the 27th of May, and we are here with Inge Heydorn and Nejla-Selma for our weekly market roundup. In today's episode, they will talk about Snap's earnings warning, tech results, Nvidia, Snowflake, Broadcom, and gaming. But first, market news from Inge. Over to him.
Thank you, Maria. Another volatile day and another volatile week in the market, really starting off on the bad foot this week with Snap profit warning and the implication that could have on the social media market, and I'll get back to that in a few minutes. But I think the rest of the results this week were very, very stable and really highlighting the stability, especially on corporate spending. And looking at the valuations right now, yes, it's very hard to say how deep this recession will be and so on. But looking at the valuation, we find a number of companies now starting to be quite attractive. AMD, for example, 25 times earnings this year. We don't expect things to fall off a cliff. And PC demand will be weakening on the commercial side also, but on the other hand, data center volumes will continue to be healthy even in a downturn. We don't expect that to slow down materially. Nvidia, the same thing, around P25 this year, and same capital equipment stocks trading at around 14-15 times this year. So we have to see a very, very material slowdown on all levels to find these valuations unattractive. And also given the fact that, remember that we are in a position in the world where the growth names, the technology names, the big names have a lot of cash on their hands. So we find it hard to believe that these names, these companies would not try to spend in this downturn also in order to stay competitive going forward. And looking at history, companies that have been cutting quite heavily in the downturns and not spending has really been hurt in the long run. Take Intel, for example. Then these companies have to catch up if they're able to catch up, and they lose both the top line and the costs. So that's a really interesting thing to think about when you think about the market at this point in time. How much really will corporate spending be affected in this downturn? Going over to Snap then, they reported first quarter results end of April, and they guided for 20 to 25% growth year over year in Q2, which was much more aggressive than the Facebook's roughly flat. So they had a really good momentum in April, stating that they were growing around 30%. So now not reaching the lower end of their 20-25% really must mean that May has really deteriorated quite a lot. So leaving May growth on the single digit basis at least. And then the second question comes on that. Is it the 50% of sales on the brand marketing that's really taking all the hit, or are performance marketing also been affected negatively? On the branded marketing side, their position is, so to say, quite different relative to the rest of the market, as the rest of the market is so much more dependent on performance marketing. That's really why the difference here between where the weakness comes from are really important when you look at names like Google, Amazon, and Facebook, and so on. The indications is that the branded marketing part is taking the major part of the hit, but Snap didn't really give any details, so we're a little bit in the dark in that sense. Going over to Workday. Workday numbers came out last night. Stock indicates 9% down, which is a little bit surprising. I think the numbers looks really healthy. Operating margin beating, sales in line, increasing the subscription revenue guidance for the full year. The only negative taken out of the results are the comments that they had some push outs of orders in the quarter. They're not saying it's macro-related, so they're even stating the opposite. They're more saying it's about the internal processes at the clients. They have not lost orders. The orders are coming through, but it will be a second half story instead. I think that's the only thing coming out that it's negative in Workday. Otherwise, everything looks very, very healthy across the board for Workday. And I would say a little bit of similar position at Zoom, very much in line, growing 11% and just humming along. The question mark when it comes to Zoom is that on the lower end, the churn is still very, very high. So the smaller companies, meaning while the larger companies are growing very, very fast. So the question mark is that mix effect and also what will happen with ASP going forward. So the 11% growth this year they're guiding for and they showed in the quarter, how will that turn out in 2023 and beyond? Is this a growth segment or not? I think this is a big, big question mark. Going over to Broadcom, yes, Broadcom is buying VMware for 61 billion in a cash stock deal. And that's going to be quite interesting to see if that comes through the regulator and so on. I think they're getting VMware at a healthy price, so it's not a bad deal in that sense. The risk is, although, that you are annoying some of the clients on the semiconductor side, but we'll see if there's another plan inside of it of spinning out some parts of VMware. Going over to the old business, I would say, in Broadcom, and looking at the semi side. The semi side grew 29% year-over-year in the quarter, which is up from 20% in the previous quarter. And the backlog accelerated up to 29 billion, up from 25 in the last quarter. So semiconductor demand continues to be healthy, and the deliveries are improving. So the demand is there and the supply is improving, which is really, really good. And also here, we need to think about, in the downturn, how much will demand fall in order to start hitting the companies really bad on their P&Ls, as they are now enjoying book to bills, which are between 1 and 1.5, all of them. So it's a very, very healthy environment still for the semiconductors. Going over to Nvidia. Nvidia numbers I thought were really, really healthy, and I was surprised the market was taking down the shares in the initial pre-trading by 7%. Yes, they got a little bit below expectations of Q2 due to China lockdown and Russia on the gaming side, but the rest of the business looks really, really healthy. And looking at the product portfolio and the ramp up of new products going into Q3 and Q4, the data center demand, automotive demand, this stock I think is going to recover, and it already did, but I think it's going to continue to recover, driven by the underlying demand for product and the strong product cycle, and the valuation is not aggressive anymore. So we really like Nvidia, and we bought some more in the setback here. The last thing to talk about is Snowflake. Snowflake numbers, I would also state, very, very healthy. Yes, they stated that they had some clients on consumer-facing side that reduced the spending a little bit, but this is also a really, really healthy segment of the marketplace. Then we can have a long argument about the valuation, which is still quite aggressive, but the demand side is still healthy. And even if we would see a really tough downturn, this is an end market which will continue to grow and be very, very healthy. Over to you, Nejla, on the gaming side.
All right, so gaming this week, we don't have that much movements in gaming. Pretty much all gaming companies reported, and we're seeing a positive forecast continuing forward. But this week is PlayStation heavy. Sony reported their earnings a while ago, as we know, but they did their segment briefing this week where they explained what each segment is doing, from Sony Pictures, etc. So I listened into that one. And I think we got quite a bit of data and info from that. PC sales number, now we got some hardcore data from Sony. So we found out how much their 3 biggest launches have sold. So Horizon on PC has sold 2.3 million units, and I really think that's a good result. And they earned around roughly 60 million revenue on that, I think. Days Gone has sold 852k units, and that's 22.7 million in revenue. And lastly, God of War sold 971k with 26.6 million in revenue. But I think it's good to keep in mind that God of War is the most recent release. So I think that number is going to climb based on reviews and stuff. Another big thing we found out is that they're predicting huge growth on PC sales this next fiscal year. They're expecting a really huge growth, as mentioned. And just to kind of put it in perspective, fiscal year 21, their net sales was 80 million, and now they're forecasting 300 million. So clearly there are going to be some big PC ports coming from Sony. I don't think you're getting that kind of a growth from just the already released games. So clearly it has to be some other big hitters to be able to predict that kind of a growth, I would say. And huge growth is also expected in terms of new IPs for Sony. One thing they illustrated was during the call that in 2019, 77% of their investments on first-party games was with existing IPs, and only 23% was for building new IPs. But now they're saying that fiscal year 2025 is going to be a 50-50 split. So new IPs are coming from Sony, clearly. And just lastly, before finishing, the release date for this year's Call of Duty has been announced. The game will hit the shelves on October 28th, 2022. So we're definitely looking forward to seeing how that release turns out. This is all for today, and thank you. See you next week. Bye!